Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
So, welcome back. Nice to have you back on the podcast.
Hey, I'm excited to be back in the office more than once per week. The quarantine period is officially done.
Matt's out of quarantine now. So, there's lots of things to talk about that we could, obviously a lot's happened since the last time we did a podcast together. I think the one thing that it might be interesting to start off on today is this dichotomy between what the economy is doing and what a lot of the economic data is coming out saying versus what we've seen in the stock market the last couple of months. And so obviously today was the first big down day in a while, but the stock market has had, a pretty good run these last couple of months. At the same time, the economy has really been horrendous. And so squaring those two things I think are things that people are having a tough time kind of understanding and getting a grip on. So how would you sort of frame that with some of the conversations that you've had and some of the things that you've been reading the last couple of months?
Yeah, well, just to back up for a second, I mean, today was a horrible trading day after the markets have gone up dramatically over the short term, and you see markets taking a pause here. I don't think there was very much news-wise going on other than some more corona cases in Arizona and Texas, and apparently in Arizona they don't believe in wearing masks. But but to comment on what you had said about the economy and the stock market being two totally different things, I think that is the hardest part for any investor to intellectualize, even institutions to intellectualize, that the economy and stock market have nothing to do with each other. And you hear everyone talking about, well, it might not be a V-shaped recovery, it might be a U-shape or an L-shape. And you say, well, I don't care what shape it is because it has nothing to do with the stock market. And why is that? Well, there's several reasons. One being interest rates. Interest rates are near historic lows, so your alternatives to place cash are very limited to get the return profile you want. Central bank stimulus is a huge factor. And also you've created this whole retail phenomenon. I don't know if you saw this week or last week. All these discount brokerages or online brokerages are allowing fractional share ownership, meaning it sounds like a timeshare presentation, fractional ownership. So you can buy 1/10 or 1/100th of Facebook shares, and you can take your $36 and trade it from your mom's basement and try to turn it into $1 million. So you've seen volume recently go up. But sorry, I'm rambling. But yes, the economy and markets are two different things. And you've also seen a real transfer of wealth from small and mid-sized business owners to corporate America.
Yeah. So why don't we jump on that piece? Because I think this is another phenomenon that I think has happened the last couple of months that, I certainly don't think it was intended to work like this, but the reality of it for small businesses or medium-sized businesses right now, whether in Canada or in the US, it's obviously an incredibly difficult environment, having to be shut down and then and really having no revenue for a lot of parts of the economy for the last couple of months. At the same time, companies like Walmart or Target or Home Depot, the really large retailers, or the mega cap tech companies that are able to actually thrive in this kind of an environment, those are all significant parts of the stock market, and in effect on a net basis have been positively impacted relative to the other small and medium-sized businesses that have been in a lot of ways decimated by this.
Yeah,
and so I think it's causing this huge chasm between what the local economies are doing, small and medium-sized businesses are, and then what the stock market's doing.
Or even more importantly, the indices are doing that are very concentrated, especially in the U.S., to big tech. But, a great example is Walmart. That's a fantastic example. You've shut down all of their competitors, and during this whole coronavirus, you could still buy from their garden center or walk around and buy groceries or do any of these things. You essentially put their competition out of business. Or let's use an example that's relevant to our portfolio, which would be cargo jet. Cargo jet, you're delivering packages all around the country and a play on e-commerce. That their business is not affected whatsoever.
It's almost
from the coronavirus. It's been every day is Christmas for cargo jet.
Yeah, I think the other thing too, if we'll jump back to the point you made about sort of this phenomenon that's kind of happened the last couple of weeks, it started hitting some of the news wires about, I think I saw a huge ad in the paper a couple of weeks ago from Charles Schwab saying, exactly to your point, you can now own fractional shares of Amazon or Apple or Google or Facebook or the like. And so you can, take $10 from your paycheck and buy a fraction of a share, which has driven a lot of this retail kind of fanaticism towards some of these story stocks. But the other thing too is we've seen, the government supports both in Canada and the US have been pretty significant from a payroll perspective. And more so in the US where they're sending out checks to people. But a lot of people, I think you can see where that retail money has received these checks. Maybe they're still receiving some income from somewhere else, and now that money then goes into a discount broker account, and then they go into buying some of these fractional shares.
Or 80% of the population is still working. You've shut down the entire world, whether it's restaurants or travel or going out and doing different social things, going to a concert or a hockey game. You now have, if you're employed and you've been staying home, you actually have more money than ever before. And I thought was quite fascinating. Williams Sonoma blew out their numbers because people are buying high-end home furnishings with all their savings, or to what we're specifically talking about, they're investing that money in the stock market, and now retail investors can participate in a way that they never were able to participate before. And that means whether it's taking your $1,500 government check and from this environment, or whatever you want to call it, universal basic income, and buying stocks. But didn't you even get a check for $1,500 because you're a dual citizen?
Yeah. So actually, so it was fascinating to receive this the other day. And so, for listeners that don't know me personally, was born in Toronto and have lived here in Canada, but through family, I'm also a dual citizen with the U.S. And so I received, the economic impact payment letter from, the IRS. I guess anyone who files a U.S. tax return, or whoever filed last year, received the same letter. And so to receive a letter in the mail along with a check for $1,200 US, irregardless of your circumstances or anything like that, it's just a matter of if you filed the tax return last year. I brought this into the office the other day and we showed everyone, and and then having sort of seen the headlines about all this retail investing phenomenon, you certainly can feel when you're given what feels like free money, how people then would say, well, I'm going to go speculate or buy stocks or, speculate on certain, a gambling attitude can take hold because it feels like free money. And for, like you said, 80% of the economy is still working, is still employed. And so to send out additional money, we would joke, I think even in previous podcasts, about helicopter money. And this is helicopter money. And so it's a crazy experience to have received this.
I'll go out on a limb and say this. I think universal basic income is here to stay. Maybe it gets pulled away temporarily, or you don't classify it as universal basic income. But if you look at the wealth disparity or things that are happening politically, especially in the United States, where people are very impoverished, and the economy is not doing well at all.
And people that have lost jobs right away.
Lost jobs. But tying this all back to how does this benefit the stock market, or how does this money end up back in the stock market? Yes, having a universal basic income is extremely inflationary, number one. Or number two, retail investors have more money or ways to participate and are sitting at home and trading stocks, and your volume's gone up. But really, this rates being brought down to where they are, where institutions or retail investors have nowhere else really to put their money, and it's ending up in the stock market. And why don't you comment on that specifically?
Well, why don't we? Yeah. So that on that point, bringing rates down to zero, I think what's been unique about what central banks have done this time, both the U.S. Federal Reserve and then the Bank of Canada now as well, is that they've both for the first time been interacting with the corporate bond market. And through buying of both corporate bond ETFs and high yield bond ETFs, it's amazing how in March and the beginning of April, the bond market, which is a corporate bond market, which is companies, accessing capital markets to borrow so they can either invest in their business or, for ongoing working capital. But the bond market really got shut down because of all the volatility and the concerns over the recession, all of those things.
There was very little liquidity.
Very little liquidity and no issuance. So the companies couldn't come to market and issue. And so when the Fed announced at the beginning of April that they were going to start buying both corporate bond ETFs and high yield bond ETFs, you had a very quick reopening of the bond market where companies could then come in and issue, and there was a ton of liquidity that all of a sudden came back to the bond market. But, we got to this problem in March because of way too much corporate debt and overall debt in the system. And then we're trying to solve the problem with even more debt. Yeah. And so you get back to this point of saying, if you look at too much debt wasn't the issue, but now the level of, I think the last couple of months you've had record issuance of corporate debt in the US, I think ever. And so the Fed have now enabled this to happen again. And you can debate whether they should do this or not. And I know there's a lot of people that would make the argument, well, the Federal Reserve is bailing out Wall Street again, and they're not paying attention to Main Street. And, I'm absolutely sympathetic to that argument. I think the other side of it that I think people have to consider is that there's a lot of companies that if they weren't able to access the bond market to issue either short-term commercial paper or intermediate-term bonds, companies would be bankrupt within 3 months.
You wouldn't be able to roll your debt obligations
or fund your payroll or your working capital. And then what that would mean is even more layoffs and job losses. So there's this balancing act that
I think what you're saying is you're really far down the rabbit hole.
Yeah. And you're creating all kinds of moral hazard that it's not there. The knock-on effects of some of the decisions that have been made the last couple of months are things that we will now be dealing with, years on from this, because I think that we've kind of crossed the Rubicon into this whole new world it's going to be much more difficult for the Fed or the Bank of Canada to not be politicized and to not be sort of blamed on either side politically because of some of the things that they've done the last couple of months.
Oh yeah. And maybe for our listeners, if you're able to do this in a simple way, why don't you explain how money with this quantitative easing or printing money effect or stimulus effect, how it's having less and less impact or less effect on the lives of everyday citizens, and how the majority of that money actually ends up in the stock market, or did I just throw you a curveball there?
No, yeah. So I think
explain it in very
So I think the initial, when the Fed rolled out their quantitative easing in 2009, 10, 11, it was sort of the initial shock and awe aspect of it. Sort of really, I guess at that time, helped confidence. It helped boost asset prices. The whole idea of quantitative easing, I think the way Ben Bernanke, who was the former head of the Fed, described it, was that you sort of boost confidence through higher asset prices. You also boost consumer confidence through the wealth effect. So, people's assets values goes up. They feel more confident. They then take that money, spend it in the economy. And it's supposed to be this circle of prosperity that happens through higher asset prices. But if you look at what's happened in the US the last, couple of decades through each of the last few recessions, is what happens is the wealth divide gets more and more extreme because people that own existing assets benefit from lower interest rates and Federal Reserve support. So then you drive a further wedge in the haves and have-nots. Then you get into a recession, and who gets affected first? It's the people that don't have assets or don't have access to opportunity or access to other things. And then, but at the same time, the Federal Reserve is limited because all they can do is, you can lower interest rates or increase interest rates. You can liquefy the system, but the Fed can't print money and actually spend it on policy. That's where, Congress comes in and the fiscal authority. And so I think the problem is there's this political divide where everyone has their argument of where money should be spent fiscally. And then that gets, caught up in a political debate. So the Fed can't really implement that, but it's easy for people to blame the Fed because they can be the punching bag. They basically have their hands tied behind their back. All they can do is increase or decrease interest rates and, liquefy the system. And so they're kind of made out to be the bad people in the room, but they're just trying to do, the most that they can.
Yeah. So currently the market is looking past all this stuff, saying, looking out a year, 2 years, 3 years, saying if interest rates are being brought next to nothing and your real rate, meaning real rates, meaning your interest rate minus inflation, minus taxes are negative. And if we're going to have such extreme policy responses, whether that's monetary policy or fiscal stimulus, markets are probably going much higher than here. And you have a handful of businesses that are going up where their cost of capital is next to nothing and they're able to fund themselves. And what do you think about the idea if we run into more volatility or more stress on markets here, that the Fed actually makes an announcement on capping 30-year interest rates?
Yeah, so I think it was interesting. So the Fed had a meeting yesterday, and I think people were maybe expecting a little bit more from them than they gave. They, said interest rates are going to be where they are, which is basically zero for the next 2-3 years. But I think that this idea about this term yield curve control has kind of been put out there, and they floated the idea really the last couple of months, and it's kind of entering the sort of the sphere of debate and conversation. And so I think it really comes back to, what's unique about this period right now is that if you look at debt to GDP in the U.S., it's back to with the CARES Act and the deficit so far this year, it's back to 100% of debt to GDP, which is exactly where it was sort of through the peak of World War II. And so you've come back to that level where the problem is at this level of overall debt, and then also the structural nature of the U.S. deficit. So because they have so much locked in spending on Medicare, Medicaid, Social Security, all these things, you basically have deficits as far as the eye can see. And so the problem now is that the U.S. government has no choice but to fund the spending. And so they're going to have to do it through higher and higher deficits, which should push up interest rates in a normal environment.
If you keep on issuing debt and borrowing money, just like a retail investor can relate in the context of their own spending habits, if you're borrowing, and you're not creditworthy, interest rates go up. But if you cap interest rates, then what happens? Yeah,
so I think what would happen is you'd have to have, and we've started to see this the last couple of weeks, where longer term interest rates, so both 30-year and 10-year interest rates have started backing up, so which means just moving higher, and short-term interest rates have stayed low. So that's called like a curve steepening. So you started to see that. So what would happen is the bond market would sniff out, wow, look at all this issuance coming. I'm not going to pay 2% for a 30-year, knowing that they're going to have to issue another several trillion. So interest rates would shoot up at the long end. But that then is destabilizing because, credit cards, mortgages, all those things are priced off of longer term interest rates. So the Fed, if long-term interest rates got out of control and just started shooting up, the Fed, I think, would have to then step in and cap interest rates, which is
the consequence of that is incredibly inflationary.
It is, because it's basically the bond market's telling you that interest rates should be higher. And the Fed is saying, no, interest rates are going to be locked at a certain rate, whether it's 2 or 3% where they cap them. And so, but what's inflationary is the deficit and the government spending that is trying to push rates up, and the Fed has to cap rates. And what's interesting is, when you talk about inflation, most people think about the 1970s. And so, you had high inflation and interest rates had to be taken up really high. And that was the last sort of big inflationary period. But if you go back to the highest inflationary period just prior to that, so the 1940s, 1950s, after World War II, the Fed did basically exactly the same thing that they're going to do this time, which is cap yields. And so if you look at, we were looking at this earlier today, but I think it's one of the most interesting charts I've seen because it tells you everything about what's going on right now and what is going to have to happen with the level of debt in the system. But if you look at where real yields were in the 1940s and 1950s, they got down to -5, -10, I think almost -15% in a year, which is, so basically what happened was you had the Federal Reserve cap interest rates at 2%, and say inflation is 12%. So the 2 minus the 12 equals -10. So that's your -10 real rate. And so interest rates should have been rising in that period, but because the economy had to recover from World War II and they had to basically devalue their debt in real terms, they capped interest rates and you let inflation take off without interest rates sort of being the stopgap.
And if you go back through history, like you referenced the 1970s or even prior to that, when you've gone through these periods of time where you have negative real rates, once again, negative real rates are interest rate minus inflation, minus you can even throw on taxes. But anytime you've gone through that environment, there, like a decade in the 1970s, gold went up 800%. 8x.
Yeah, 8x. Yeah, I think what's interesting is when you look at it, in the 40s and 50s, gold was still tied to the dollar, so gold wasn't allowed to free float. But there was the very famous example in the 30s when, maybe 1933, when FDR basically confiscated everyone's gold in the U.S. Basically made it illegal to own physical gold. Took it in, and then as soon as they took it all in, they devalued the dollar versus gold, which is kind of a huge way that they got out of the Depression because it was this huge monetary easing that the system needed. And so in the 40s, you didn't have gold free floating. So it would have been interesting to see what gold did in that kind of environment when real rates were that negative. But to your point, when you look at the 70s, and similar thing happened where you had real rates go down to maybe -4, -5%. And to your point, gold took off 8x. And so what's interesting about today is that I think you have the same, if not worse, dynamics on the government debt to GDP side. And it's getting, it's going to get even more out of control. And so I think that whether they want to or not, and I'm not sure if Jay Powell will be the Fed chairman to do this, but they're going to have to devalue the value of that debt in real terms, which will be done through higher inflation and capped yields, which then, if you look at the setup on gold today, I mean, the chart, we were looking at earlier, the setup is exactly the same as the 70s.
It is, and it's eerily similar. So you can always make this argument to have 5-10% of your portfolio in precious metals, especially going into an environment like we are now.
I think what's interesting is, and when I have conversations with people about this, and we've sort of been in some of the same conversations where people, there'll be a 10-year period where gold is actually the absolute last thing you want to own, and it has no value in your portfolio for any kind of diversification. And then you'll go through periods where gold is something you have to own because of when you can see that sort of these dynamics happening where you're going to have paper money get devalued against any kind of hard asset. And it's interesting how I think we're definitely not gold bugs, but we just look at the scenario and can say, well, we know that it's some a sector that we want to have exposure to, but and if things change, we would just as quickly become negative on gold. But it's interesting how I think the entire large portion of the investment community is still scratching their head as to why they should own any gold or hard assets, because stocks have done so well for the last decade. But
they forget where you've gone through periods of time where stocks don't do as well, or you go through a period of stagflation. I'm not saying that's what's going to happen, but you do want to own these things.
So I think, if we were to wrap up on what, if you were to say some of the key things that you're looking at for the next few months to signal, what direction, whether the markets head from here, or, are you looking at sort of focusing on whether it's, corporate earnings, or are you expecting any announcements from the Fed, or what would be your as we head through these summer months, what would be some of the things that you think investors should be focused on?
I think going in, one, you shouldn't be in the stock market unless it's long-term money and you're buying quality assets or businesses and intellectually viewing it like a business owner and buying companies that are profitable. But in the short term, I think we probably head into some volatility into the election. I think that is a key catalyst. But I think if markets do come off in any strong way, the policy response from the Fed will be quick and it will be severe. And any of these things, whether it's having universal basic income for longer, or that gets put on the table, or the Fed buying more assets, or I think there's a lot of things that are on the table.
Yeah. So I think, and I totally agree. I think that the policy response is going to be critical, because it'll be interesting to see how far they'll let the markets go down if we go through a period of volatility before they come in with another round of stimulus or support, and at what level.
And you always hear about the talk about the market. Well, it's really important to understand, what do you own and why do you own it? What does Cargojet have to do with small and mid-sized businesses or the current economy? Or what does Enbridge have to do with the virus? A lot of the businesses you own have some sort of stability or predictability in their cash flows. And I think with interest rates being where they are and this re-rating of valuations, that it's not all the dynamics that are going on out there, and you hear this word that markets are irrational. I think it's completely rational considering the circumstances. It doesn't mean it's not based on always based on fundamentals, or there isn't an air pocket in certain stocks or sectors, but you can understand why this is happening.
Yeah, and I think it's I keep coming back to the most important thing is you just have to follow and trust and respect the price action, and a chart tells you 1,000 words, and I think sometimes people try to frame a story about what should be happening because of XYZ, rather than just saying this is happening and then trying to understand why, and it's kind of reversing how you think about it.
No, absolutely. And I hope you get some this free money that you're getting from Donald Trump. I think Trump even signed the letter. Did he sign it?
Yeah, he signed
personally.
He did sign the letter. I don't think personally.
The Donald. What a crazy guy.
So I think this definitely opened my eyes to what it feels like to get quote unquote free money, and for retail.
Did you spend it on stocks?
No, I haven't. I've saved it.
Saved it. There you go.
But anyway, so why don't we wrap it up on that, and then we'll look forward to the next chat.
All right.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, Google, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.